Round and Search. True traders react to the market.
Hi, I'm Kelvin from Round and Search. Today we will be sharing how to read company announcement on the right issue. There are many investors in the market who find it difficult and confusing to understand the announcement and how this corporate action will affect your investment holdings. So before we start, remember to subscribe to our YouTube channel and turn on the notification bell to get updates for our new video. Right issue means that you have the right to subscribe for the company new listing ordinary shares, warrants, preference shares, or some other form of securities. The intention of the right issue is to get listed companies to raise funds from their existing shareholders. Shareholders can vote on such proposals during AGM or EGM, and if you are a small investor, it usually will not have much effect on the voting because you don't hold enough of shares to cover the majority of the votes. You may check the proposal details of the right issue under General Meeting, Notice of Meeting, and for the details of calculation or subscription process at the Circular or Notice to Shareholders. Having right issues can be issuing various forms of securities such as new ordinary shares, preference shares, warrants, or even stock loans. All of this will have a direct and indirect effect on the existing shareholders if you don't subscribe to it. A direct impact to shareholders will be issuing new ordinary shares. There will be new shares in the market, therefore there will be a dilution of shareholding if you didn't subscribe to the new share issue. For example, company ABC currently share issue amount is 100 units of shares and the price of the share is 1 ringgit per share. If you are one of the shareholders in this company holding 5 units of share, which is equivalent to 5%. During the AGM, the company proposed to issue an additional 100 units of share to raise fund with the subscription price of 50 cents per share. You will have the rights to subscribe additional 5 units of shares based on your existing holding 5 units of shares in company ABC. However, you don't want to commit more into company ABC because you find that the investment into this company is not profiting you. So you refuse to subscribe to the shares. And on the listing day, a total of 200 units of shares are in the market and your shareholding is from 5% is now fall down to 2.5%. Because the total units of shares increases but your shareholding is still 5 units of shares. The price per share will also be adjusted due to more share units are being issued to the market. With the price adjusted lower doesn't mean that you lose the value because if you subscribe the shares, you will have to make additional payment of 2 ringgit 50 cents for the additional shares from your pocket. If you don't subscribe to it, the original value of your holding is 5 ringgit and now on the new shares listing day, the new price per share for 200 units of share is now 2 ringgit and 50 cents. So in your portfolio, you lose 2 ringgit and 50 cents. It is about the same as you pay to subscribe the new shares. For retail investor, the decision to subscribe for the new shares shouldn't be focusing on how many shareholding you are holding after the new shares are issued. You should focus on the return of such investment. Will it be profitable for you to invest more? If it's not, you shouldn't be buying more shares just to maintain the shareholding. You should stop your losses by not investing more. For preference shares, warrants, and loan stocks usually will have lesser effect of price adjustment during the listing day because it has no direct new issue of ordinary share. It is more like the sub-securities of the ordinary shares which directly affect the company total unit of share issue. The dilution will come later if the holder of such securities exercise their right to claim the ordinary shares in the future. Then the company have to issue new shares for such claim. If it is worth taking up the right issue, you will need to hold the shares up until the X date in order to be entitled to the right issue. Don't mistake X date and entitlement date. In order to be eligible for the rights or dividend, you are required to own the shares before the X date. Entitlement date is for the company to record the shareholder entitled for the rights or bonus. So if you buy shares on the entitlement date, you won't be eligible for the rights or bonus. If you really want to be eligible for such entitlement, you will need to have the shares in your CDS account by the X date. Once you have decided to subscribe to it, you may download and read up the abridged prospectus to understand the risks and the fund utilization for the right issue. Then fill up your details and CDS account number in the right subscription form, which we call it RSF, and submit to the company shares registrar company. There are some company share registrar offers online submission, so you may check with the registrar for more information on this for your convenience. When submitting the form together with the payment by check or online transfer before the last date and time for acceptance and payment stated in the announcement details in order to entitle for the rights. Let's take a look into the example below to understand better on the entitlement ratio. First, we need to identify what are the securities being issued. From the first sentence, you will see renounceable rights issue of up to 1 billion new ordinary shares. This means that there are new shares will be issued for us to subscribe because it did not state that it is free. Then the next sentence, you will find that together with up to 400 million free detachable warrants in ABCD, there's a new warrant listing in this corporate exercise given free to shareholders if they subscribe the new ordinary shares. And in the next sentence, you will find that on the basis of 5 right shares together with 2 free warrants, for every 1 existing share held by the entitled shareholders of the company at 5 p.m. on 11 August of 2021. So this means that if you are an existing shareholder of company ABC, let's say you are holding 10,000 shares. Based on the above, for each shares you hold, it will entitle the rights to subscribe for 5 new listing shares plus 2 free warrants. In this case, you will be entitled to subscribe a total of 50,000 ordinary shares and comes with a 20,000 free warrants if you subscribe for the rights issue. So how much do we have to pay to make this a right issue? From the next sentence, you will see new ordinary shares in ABCD Berhad at an issue price of 10 cents per right shares. The new share issue price is 10 cents per shares. Therefore, for 50,000 unit will be 5,000 ringgit and you will be entitled for an additional 20,000 units of free warrants. So you don't have to pay for the warrants because it is free. So in general, if you don't see any words free or bonus in the first sentence and state how much of the issue price per right share in the right issue announcement, then you will have to subscribe for the additional shares. A gentle reminder to every investor again, the decision you make to subscribe for the right shares should always be based on the potential growth. It shouldn't be maintaining the shareholding percentage or don't want to lose more money. Like I've shared earlier, that the losses incurred by taking or not taking up the rights is about the same. So invest wisely in the stock market. Don't invest with your feelings. So that's all for here. Remember to give us a like and subscribe to our YouTube channel so you can share this video to your friends who don't understand what is right issue in the future. So see you next time.